Hello and welcome to another video on how to secure yourself financially. So in today's video, I'm going to make a quick recap of this beginner guide to financial statement. After all, they show you the money. That's what financial statements do. They show you the money, and there are four of them. Balance sheet that show what a company owns and what it owes at a fixed point in time. The income statement, how much money a company made or spent in a period of time. The cash flow that show is the exchange of money between the company and the outside world, as well as the statement of the shareholder, which it shows the change in interest of the shareholders over time. So the TLDR of the balance sheet is a snapshot of the company assets, liabilities, and shareholders' equity. The income statement shows if a company made a profit or not, and the cash flow statement, where the bottom line of that statement shows if a company the net increase or decrease in cash over a period of time. So I'm just going to elaborate a little bit more about the cash flow statement. So this reuse some information of the balance sheets and the income statements, and it is important because companies need to have cash on hand to pay this expense or to purchase assets. Not only company but also people. And this cash flow statement generally review the cash flow from these three type of activities: the operating activities, where what it does is to conciliate with the net income from the income statement and the total amount of cash that was used or perceived from operating assets or liabilities. Operating activities. So most common operating activities are operating assets and operating liabilities, where on the first we have something like cash flow, accounts receivable, inventory, prepaid expense, or expense that a company incur for service that will be received in a period of time, or will be received in a period of time, okay? And the company has paid for that. In other words, expense that a company made from good and service that has not been received yet, okay? So here we have, for good and service that has been that will be received in the future. So for example, premium insurance, such as medical coverage for like health, for medical coverage, home, vehicle to protect those belonging, life in the event of the policyholder's death, the liabilities. And when it comes to how do you say that? There's liabilities. When it comes to lawsuits, disability that prevent you from working, or long-term care like home health care or nurse health care, marketing, rent, office supplies, software license, and maintenance contracts are another example of this prepaid expense. Intangible assets is another most common operating assets, such as patent, which is exclusive rights to creator of original world, to inventor, so they can manufacture, distribute, and sell their invention over a period of time. An example of this is like most common examples or patent that changed the 21 or 20th century are the maglev, this electromagnetic inductive and stabilization system for ground vehicles, issued in 1969, a GPS, or as a patent name called the navigation system using passive ranging techniques, as well as that license, that patent was issued in 1973, electronic device, aka the iPhone, issued in 2004, decreased gene editing, issued in 2014, as well as the 3G mobile communication, which is now a standard under the 3GPP, okay, 3GPP, okay. This umbrella term, or this third generation partnership project, which is an umbrella term of a number of standard organizations which develop and maintain protocols for mobile telecommunications. And this is an issue that most companies, or if we go a little bit back at the beginning of how the U.S. born, okay, how these different colonies, these dissident colonies from the UK or Dutch dissidents now go to North America in search for a new home, a new place to begin with. So you have Plymouth or the Virginia Company. So back then they have problems to communicate, especially across the channel or across the Atlantic Sea. And they have to develop down the road, okay, if we take a look at only at the technical aspect, without involving anything related to economy or social, only the technical aspect of dealing with this kind of problems. So that's the reason why they create the Morse code. Morse code now no longer in use. Okay, the Morse codes, and then now companies have to set. So now that a lot of companies face a lot of problems, especially in communication, well, in 1998, they create this third generation partnership project, okay, which is an umbrella term of standard co-organization, which again develop protocol for mobile telecommunication, which include is development and maintenance. Okay, for example, DSM, which is related to 2G, a 2.5 generation, UMTS, this Universal Mobile Telecommunication System, okay, and related 3G standards, LLT, and long-term evolution, which is related to the 4G standards, and now the 5G and related 5G standards. Why am I talking about this? Okay, this is a good example of pattern that changed the world, when we're talking about here intangible assets like or operating assets like intangible assets. So creating license is something that has tremendous impact in the future. Okay, So I just want to broaden that out here. Another intangible assets are trademarks, which are exclusive image, audio, design that uniquely identify this company from the competition. So, for example, the famous quote from Michael Buffer, "Let's get ready to rumble," is a good example. Copyright, uh, which are exclusive rights to creator of original works, so they can manufacture, distribute, and sell their invention over a period of time. Twitter, Disney, Spotify, Netflix. Goodwill, which is the brand recognition, reputation, and customer loyalty, as well as the trade secrets, this confidential data that company use to gain some competitive advantage, whether it's for process, whether it's process, how do you say it, process, operations, or customer list. And then I look at another operating asset, which is the investment in affiliates. So this, it's more like it's when a company purchases significant amount of stake on the another company to influence, but not have total control. The whole point of this is to earn a return on investment, or and gain competitive advantage. Joint venture is a good example of that. A partnership between two or more companies to undertake a specific business activity where each part receives a share from that. So, for example, Crocs, okay, Crocs and Post Malone. That's right. So Crocs and Post Malone. So they launched this collection here. You see gold and collections of Post Malone Crocs. This is a joint venture. A good example of that. Another is equity investment, where now this is when a company purchases significant amount of stake of the another company to gain some influence and potentially influence in the another company management decisions. So, for example, Berg, 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 Berkshire Hathaway. Okay. So, for example, Berkshire Hathaway, led by Warren Buffett, which is a holding company that invests primarily in sectors like energy, real estate, retail. SoftBank, which is a Japanese conglomerate, SoftBank, that primarily invests in technology companies such as Uber, WeWork, Airbnb, Alphabet, which is the Google parent company, Alphabet Inc., that again invests in primarily in technology companies. Okay, so they do that through it is venture capital arm called Google Ventures. Okay, also we have things like Texas Pacific Group, which is a private equity that invests primarily in real estate, healthcare. Okay, like this. It's a private equity. And then I also look at another common intangible asset or equity. In this case, is investment in affiliate, joint ventures, equity investment. Joint ventures, equity investment, associate, where now a company owns something around 20 to 50% of the another company's shares. Limited partnership is limited partner partnership. Okay, so limited partnership, where here is when an investor or a company purchase significant amount of stakes in return of the partnership's management decisions and ownership. So this is just an example of this most common intangible investment in affiliates, right? And then I also look things like cash and cash equivalents. For example, money market fund or money like this, where now this is a fund that involves in the purchase and sale of large volume of very short-term uh, debt product, okay, such as bank acceptance or short-term debt issued by banks, certificate of deposit, okay. Datum is like this. The certificate of deposit with bank issuing savings certificate with short-term maturity, commercial papers, unsecured short-term corporate debt, repurchase agreement, where now this is short-term government securities, and the term security refers to a fungible financial instruments that hold some monetary value, okay, and depend on how it's being issued, it can be equity based or debt based. So meaning you can be a equity, so you can be an equity holder or a debt holder in that purpose, in that regard. When for an example of equity is when you purchase share of a company, and an example of debt equity or debt ownership is, for example, when you purchase bonds from a company or from a government. And then the US Treasury, which is short-term government debt issue. Okay, so okay, uh, and then I look at the most common operating liabilities, such as accounts payable, money that you own to your suppliers and vendors, usually in a 30 to 60 days loan. Okay, and because of that, uh, so example of this accounts payables are, for example, raw materials, or office supplies, service, accrue expense, which are expenses that a company incur for good and service that has been received but not yet paid for, such as rent, utility, taxes, and salaries. Deferred revenue, which is obligations that a company have to provide good and service. On Spanish, this deferred revenue is ganancia diferida. Okay. So this deferred revenue is something like that. And So this is the first revenue, okay? In Spanish called ganancias diferidas. Okay, it's an obligation to provide good and service in the future. For example, subscription service, gift cards, tax payable or tax income taxes payable. Well, now this is money that you owe to the government, whether it's corporate taxes or withholding taxes, which is a portion that your employee deduct from your gross salaries and pay that to the government. This is to promote the pay as you earn tax system and to fight back tax evasion. Or it can be sell taxes, whether it's by your federal, state, states, local, and or excise, which is a tax imposed at certain goods such as tobacco, alcohol, gasoline. Tobacco, alcohol, gasoline, and guns. VAT, this value added tax, which is a tax imposed on the production at every stage of a good or service, the production and distribution, where the customer ultimately pays the full VAT, and you now or business along the supply chain remit that portion to the tax. I also look at short-term borrowings, which is operating liabilities. This is for companies that want to meet their financial needs or working capital, which is a measure, one of the multiple measures of determining the financial health of a company, your working capital, which involves the difference between the current assets plus or minus the current liabilities, right? So if a company has if a company has a huge positive working capital, it can indicate that it's not taking or it's not seizing some investment opportunity or so that investment opportunity. So here, this short-term borrowing can be from banks or for companies, whether it's from a when it comes to companies or business in this case, it may come from financial institutions like venture capitalists or another financial institution, so like private equity, trade credits, or this line of credits provided by banks. Trade credits, okay, but when now you renegotiate, in some case, companies can renegotiate the repayment schedule with their suppliers and vendors. Outstanding invoice, so based on the value of your invoice, you can ask for short-term borrowers to individuals or other business. And payroll advance, where this payroll advance is when an employee asks for an advance, so in the next payday that will be deducted from it. Notes payable, okay, or in Spanish this is called as notes payable or pagarés. Notes payable or pagaré, which is an agreement between the borrower and the lenders, where the borrower outline all the terms and conditions of that loan. So things like bank loans, they generate these notes payable. Well, where they define is the principal, which is the original amount borrowed, as well as the interest, the repayment schedule, and another example of that is yes, these bank loans uh, from governments, or in this case for business. So anytime you ask for a loan to a private investors or private equity or venture capital, they generate this notes payable. Also for trade, let's say for your suppliers and vendors, you can also renegotiate with them, and you generate is this notes payable to that. Governments, bonds or corporate bonds actually generate this notes payable. Individuals can do that as well. And then I look at the warranty and obligations, where these are an obligation that a company has to uh, fix or replace a defective product or a product that doesn't meet with certain quality standards. Okay, I think you have like manufacturing, like manufacturing. How do you call that? Like manufacturing. Manufacturing warranty, parts, software, service, installment, that kind of thing, right? So with that overview, okay, then I look at the uh, investing activity that generally involve if the purchase. This is the second part of the cash flow statement. So if you take a look at the Yahoo here, second part of the cash flow statement. All right. Second part of the cash flow statement. Cash flow from Coca-Cola. Okay. That's right. Okay. So yeah, the second part of this, the investing cash flow for that. Uh, this generally involves the purchase of the purchase or sale of long-term assets. So long-term assets are a couple examples are intangible assets, patents, copyright, trademarks, goodwill, customer relationship, property, plant and equipment, investment, installment, leasehold installment, okay? And then I look at the financing cash, okay? Which is the third part of the cash flow statement. So these sections, according to Investopedia, it focuses on how a company raised funds and paid back to creditors or investors through market capital. So financing activity involves in the company's long-term liabilities and equity. So most of the time this involves in, or the activity involved in the financing is, from the company perspective, is raising funds from creditors or investors, repaying debt, and distribute dividends. Okay, so just a couple examples here is issuing equity. So, for example, a company can issue shares of ownership uh, in an initial public offering, IPO. Issuing debt. So, if a company wants to raise capital uh, by issuing financial debt instruments, such as financial debt instrument. Okay. So financial debt instrument. Such as corporate bonds. Such as bonds. And so this financial investment here. Okay. When analyzing this financial cash flow here. Uh, this I just mentioned is a couple example here. Here, like issuing equity, issuing debt, uh, repayment debt, repurchasing stocks. Okay, this is also to increase their stock value as well. It's another tactic that most companies I think that they use for. As well as the how do you call it? Issuing equity, issuing debt, repayment debt, distribute dividends, repurchasing stocks, convertible debt is another example. Okay, so and long-term asset examples here. Financing activity, leasing, very important here. Okay, so issuing equity. This is when a company issue or raise capital by selling share of common stocks. Issuing debt, when a company wants to raise funds by issuing debt instruments such as corporate bond, debentures, or notes payable. So notes payable or bonds, repaying debt, obtaining loans, distribute dividends, repurchasing stocks, leasing. Okay, so leasing is this is when a company enter into a lease agreement to acquire an asset, whether it's a building or equipment, without taking ownership on that. Leasing and convertible debt. So with all of these examples, okay, uh, so this section here help the financing cash flow section give investors the opportunity to know where the money is coming from. Okay, where the money is coming from, where the money is coming from, and how much funds the company is raising. Okay, how often a company raise fund, and Yeah, how often a company raises funds here. Like this. So how often a company raises funds, okay? Yeah, how often a company raises funds and where these capital are coming from, okay? And for example, if a company, so if the cash operations comes from, so if in a cash flow, um, or if a company receive, or if the primary source of cash flow comes from operation, that's a good sign of a good investment. However, if a company is constantly raising funds by issuing stocks or taking out of debt, that might be a not that might be an indicator of not a good sign of that. Okay, okay, that's good. That's good. So once I look at that, okay, because they don't show you is the footnote, and it's important because the footnote of a financial statement are packed with information that contain something like the accounting policy and practice is how this company is adhering to accounting principles, and it's important that the company disclose this kind of information. Uh, so, for example, if they follow is the GAAP principle as well as other methodologies, where GAAP is the general accounting accepted principle, like this. The generally accepted accounting principle for U.S. public company or the international finance reporting standards. And the whole point of this is due the expansion of companies and becoming multinational companies. Okay, now these standards emerge. Okay, these standards emerge to make company to make financial statement uh, consistent, transparent, and easily comparable. Okay, so the whole point of this EFR, okay, which is a set of accounting rules for financial statements of public companies that are intended to make them consistent, transparent, and easily comparable around the world. That's the whole point of this. Understanding international financial reporting. But that's the whole point of this, or one of the, or yeah, that's the whole TLDR of this IFRS. Okay, IFRS, which is one of the things that are in the footnote, at the footnote in the financial statement. So the accounting policy and practice, as well as income taxes, which is breaking it provide more information in a detailed way. It provides detailed information of the state or the federal, state, local, or foreign taxes, as well as pension plans, or what are the practice that this company is taking for their employees when it comes to pensions. This is something that is here. Okay, so pension plan and other retirement programs. So the footnote discuss the company's pension plans and other retirement or post-employment benefit programs. Okay, and that section discusses pension plan and any other retirement or post-employment benefits programs. The note contains specific information about the assets and costs of these programs and indicate whether and by how much the plans are over or underfunded. And the stock options. So the note also contains information about stock options granted to officers and employees, including the method of accounting for stock-based compensation and the effect of the method on report results. So this contains information about the stock options granted to informers and employees. So what are our stock options? That's the question. Like what is stock options? What are stock options? A financial instrument that give its owner the right but not the obligation to purchase a given asset at agreed upon price and a date. A financial instrument that gives its owner the right but not the obligation to purchase a given asset at an agreed upon price and date. Okay, so you have the right to buy this, not the obligations, at a given agreed upon price and date. Okay, stock options. And the stock options also known as equity options. Equity options, equity derivatives, definition and how they're used and examples. Forward and futures, options, warranties, swaps. Forward and futures, options, warranties, and swaps. Understanding equity derivatives. Equity derivatives definition and how they are used and explained. An example. Investors can use equity derivative to hedge the risk associated with taking long or short positions in stocks, or they can use them to speculate with. So these equity derivatives are being used to speculate on the price movement on the underlying assets. Understanding equity derivatives. Equity derivative can act like an insurance policy. The investor receives a potential payout by paying the cost of the derivative contract, which is referred to as premium in the options market. An investor in the options market. What is an option? In the options market. In the options market. Oh my God, here we go. In the options market. What the hell is even this? In the options market. The options market. What are options? A financial instrument that is based on the value of underlying security, such as stocks. Oh my God. So, it's somewhat similar to this cryptocurrency like USDT is fixed on the value of an underlying security such as stocks. Oh my God. So these options is a financial instrument based on the value of an underlying security such as stock. The term option refers to a financial instrument that is based on the value of the underlying security such as stocks. An option contract offers the buyer the opportunity to buy and sell, depending on the type of the contract they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. Each option contract will have a specific expiration date by which the holder must exercise their option. The state price on an option is known as the strike price. Options are typically bought and sold through online or retail brokers. Options are financial derivatives that give buyer the right but not the obligations to buy and sell underlying asset and agree upon price. Uh, yeah, but an option is an underlying is a financial instrument that is based on an underlying value, or that is based on a security underlying value. Though, okay. So if the security doesn't exist, the option evaporates. So there is no, okay, it's an option. Call options and put options from the basis of the wide range of option strategy designed for hedging income or speculation. And most of the time it's from speculation. Option trading can be used for both hedging and speculation, with strategy ranging from simple to complex. Although there are many opportunities to profit with options, investors should carefully weigh the risk. Understanding options. Options are versatile financial products. This contract involves a buyer and a seller. When the buyer pays a premium for the rights granted by the contract. Call options allow the holders to buy an asset to mean okay. Oh my god. Oh my god. Okay. So this start with stock options. Okay? With stock options. So okay, so so okay. Okay. Alright. Okay. Interesting. Interesting. Okay. So that'll be all for this video. Okay. Because after I dig, this is something that I'm going to dive into it. Okay, the stock options. Because I understand is some of the highlight that this footnote at the bottom of the financial statement mention, which is significant accounting policy and practice, is that companies are required to disclose accounting practice and policies if they're following is a particular principle or rules, whether it's GAAP on the US for public companies or the EFRS or this international financial reporting standard. Okay, where the whole idea of that to the increase or multinational corporations is to set a standard or set a standard for financial reports when our companies can put this information, make them more transparent, transparent, okay, which is this, which makes them transparent, consistent, and easily comparable around the world. Okay. Income taxes. With this section is elaborate and mention is what are the type of taxes that a company have to pay from federal, state, county or local and foreign. Pension plans and other retirement programs. And this section discusses the company pension plans and other retirement or post-employment benefit programs. The notes contain specific information about the assets and costs of these programs and indicate whether and by how much the plans are over or underfunded. Very, very important, especially if a company, if you can have access to that information. And the other is stock options. So, stock options is a financial instrument. Is all of this financial jargon, okay, which is a financial instrument where their value is based on an underlying security, such as stocks, stock options. Okay, so with that, that'll be all for this video. Take care. Bye bye.